If most of what you know about crypto comes from the news or casual chats with friends, then, I'm sorry to tell you this, but you probably haven't got the whole idea. If you want to make money at something, you need to know everything there is to know about it. There is a lot of buzz about cryptocurrency right now. Since it is the only thing that has made a lot of millionaires in the last 10 years, before you start your crypto journey, there are 7 things you need to know. Check out the best hardware wallet on the market as well. How it works. Bitcoin, the first cryptocurrency, is a type of digital currency that was created in 2009 by an anonymous person who went by the name Satoshi Nakamoto. Cryptos are not run by a bank or government agency. The transactions of cryptocurrency tokens are instead recorded on a public blockchain, which is a database of digital information. Their future remains doubtful. Tokens or coins used in a decentralized network are not the same as shares in a business, says Michael Anderson, co-founder of Framework Projects. It's risky to deal with digital currency. Putting money into cryptocurrencies is a very risky move. Like most new businesses, a lot of crypto assets would fail, making them worthless. When investing for the first time, people should only put in money they don't mind losing. Investing at the wrong time, when there are reports of investors making millions, will cause you to lose money quickly and in a big way. As late as May 2017, 1 unit of Bitcoin, BTC, sold for about $1,500. In December 2017, Bitcoin reached a high of $19,800. BTC's price has been between $6,600 on April 15 and $10,000 on May 7. Even though investing in cryptos seems like a good way to get rich quickly, this market is very risky, and there is a real chance of losing a lot of money. Crypto can be used in many ways. Some shady deals have been paid for with cryptocurrency. And yet, legal businesses are now starting to accept crypto payments. Cryptos let you send money quickly and for a low cost. Because of this, they are often used to move money between countries. A $99 million Litecoin, LTC, transaction took only 2.5 minutes and cost the sender less than $1 in transaction fees. Cryptos aren't controlled by the government, and they can't be frozen. This is because the asset can only be accessed by someone who has a private key to the wallet. When listing cryptocurrencies, investors can also bet on which ones will do well and which ones will fail. Investors have a lot of options. One way to deal with investments in cryptocurrency is to make it easy to speculate. Still, there are different ways to invest in cryptocurrencies, just like there are different ways to invest in stocks. Marcus Swanepoel, CEO of Luno, a global cryptocurrency company, says that you can day trade cryptocurrencies, buy and hold them, and study the money by doing fundamental and technical research. Even though it's hard to predict the lows and highs of digital currencies, Swanepoel says there are ways to analyze the market that can tell investors when to buy and sell. Cryptocurrency assessment techniques include principles such as asset availability, demand, and future applications. For example, the number of bitcoins that can be made is fixed at 21 million. Because the number of bitcoins that can be made is fixed, demand will drive prices up. The IRS doesn't count cryptocurrency as money. The Internal Revenue Service in the United States looks at cryptocurrency as property. Investing in cryptocurrency is also subject to the tax laws that govern investing in land. Robert Elwood, a partner at the Philadelphia law firm Practice, says, "This ruling requires a lot of records to be kept, and the IRS is putting a lot of effort into tax enforcement for cryptocurrencies because of the steep penalties. Transactions should only be made in taxable accounts when it is worth the trouble of keeping records." If the 2020 Virtual Currency Tax Fairness Act is passed, it could lead to more people using cryptocurrencies because taxes would only be put on digital currency if a transaction made more than $200. This will make it easy for people to pay for small purchases with digital currency. Still, cryptos kept in retirement accounts are tax-free, just like everything else in these accounts. Many crypto coins will likely fail. As with any market, the future of cryptocurrency is not set in stone. Robert R. Johnson, a professor of finance at Creighton University, says, "I think that in a few years, cryptocurrencies will implode and cease to exist in any meaningful way. The whole market for cryptocurrencies is a bubble." Johnson says that the cryptocurrency market is driven by the greater fool theory, which says that investors count on new buyers to bid up the price. If Johnson is wrong and the demand for cryptocurrencies doesn't drop, the question of whether or not they can survive still stands. With thousands of new companies and products coming into the market, not all of them will last. Investors who want to gamble in this market should probably stick to the most well-known brands, like Bitcoin, Ethereum, and Litecoin. Before investing, it's also a good idea for each person to learn a little bit about the market. You can lose all your cryptocurrency. Since cryptocurrencies are digital and don't have a central place to store them, account balances can be lost. For example, if a computer crashes without a backup, a cryptocurrency stash could be lost. If a user loses the private key to their wallet, they can't get back any of the cryptocurrency they have in it. Scammers can even take over someone's mobile account by pretending to be the account holder. Thieves call the carrier and ask that the user's SIM card be moved to a new phone. This lets scammers get into cryptocurrency accounts. Investors are responsible for keeping track of their private keys and using the best cryptocurrency hardware wallet. The experts also say that you should back up your cryptocurrency private keys and use strong passwords. If you enjoyed the video, don't forget to subscribe to our channel.